Welcome to Life Isn't Lived on a Spreadsheet with Ryan Poterack from Poterack Capital Advisory. You have unique values, objectives, fears, life experiences, and biases. Any financial professional who ignores or minimizes the importance of your story may not be able to help you achieve your ideal outcomes or hit your goals. It's time to experience the PCA difference. In this podcast, we help business executives, soon-to-be retirees, and solutions-based individuals overcome the anxiety leading up to their upcoming years. We do this by initiating in-depth discussions about the financial aspects of retirement, like tax planning and asset allocation, alongside, and often overlooked, personal and lifestyle aspects. Join us for this journey where we explore retirement from a contrarian point of view, as Ryan draws from years of experience and qualified guest professionals to help you explore the true purpose of your money in retirement and the impact you want to make in your golden years. Ryan Poterack and Alec Quaid offer investment advice through Private Advisor Group, which is a federally registered investment advisor. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. Private Advisor Group and Poterack Capital Advisory are separate entities. This information is not intended to be a substitute for individualized legal or tax advice. Please consult your legal or tax advisor regarding your specific situation.
How many times have you heard you should invest for the future and that you have to spend money to make money? Well, there are costs associated with investing. Some are called fees, and you may not be aware of them. Ryan Poterack, wealth manager at Poterack Capital Advisory, and certified financial planner Alec Quaid want you to know about the different types of fees and what they can mean for your investment returns. So, Ryan, true or false? Most fees are small and really don't matter.
Well, yeah, there's a couple of terms there that would be completely relative. What is small and what matters to the particular client? I just would say fees, or if we equate fees to the cost of something, cost of a service, I believe it's always about value. Now, we go to great lengths to educate clients and prospective clients about fees and expenses, where to find them. But that's always because people understand fees when they're converted to dollars and cents. And with that basic understanding, then I think a client can equate the dollars they're spending with what value they're getting, in this case, from their existing financial firm, if they work with one, or our clients and the value they get from us. But it's always about value, because the default, I think, with the public, and I understand why, it's probably with a lot of different industries, is that less expensive is better. It's a win. But that's not the way people go about their lives. They don't go about their lives buying the cheapest of everything. If they do, then they've got, they got a lot of heartache to share with people as well. So one analogy that I don't know if it ever gets traction, but Patrice, I have a $5 bill to sell to you for $1, and I have a $10 bill that I'm selling for $3. Which is more expensive?
Alec, I need your answer.
Well, if I'm selling the $10 bill for $3, $3 is more than $1. But where's the value? If you were to buy a $10 bill with $3, you get a better value situation than buying a $5 bill with $1. So right. I guess, again, I don't know if it has any traction, but sometimes I throw that one out there, and there I did.
Yeah, that's good. And I think, and everyone gets to decide for themselves, right? And to your point about value is what's valuable to them. Is a professional's knowledge and advice over time valuable to them or not? I mean, someone should only hire a wealth manager and pay the fee if they believe that the value that they're receiving is really in multiples of the fee that they're paying. Point blank and simple. Everyone gets to make that decision for themselves. And our clients, I would imagine, since they're paying our fee, feel that our value is in multiples of our fee. There's lots of folks out there who would want to do investments or do their financial planning on their own, and that's fine. They get to make that choice. Those people aren't our clients, obviously. So I think one of the questions that I always pose back to people when they are asking, well, what do we cost? What is our cost? What's our fee? And whatever it is for that person, the question that they need to answer for themselves is, well, what's the cost of you not having someone help you? over time. There's a lot of what we do, Patrice, that is hard to quantify. And it's hard to put a specific dollar amount. It can be intangible. But for example, if we talk a client, which we have many times, off the ledge of selling out of a bad market, a bear market situation, and they follow our advice, market recovers, how much money did we save? Well, you can't fully quantify a number on that, but potentially hundreds of thousands of dollars, right? And our value, as Ryan says, stealing his line, is lumpy over time. And that just means that in some years there's more going on with a client situation than others. And having a trusted relationship that you can go to when those life situations happen where we can really help, makes a big difference.
We talked about on another podcast recently, Patrice, about inheritance and estate plan and all those situations. And sometimes when our client loses a parent or loses a spouse, we're just about the most important person in that individual's life to just help them calmly handle all of the associated issues that might arise from losing a spouse, and losing their pension or the Social Security changing, or maybe the spouse that passed away primarily handled all of the investments, and the surviving spouse that we're talking to right now doesn't have any idea of that stuff. I mean, there's so many situations in which, when Alex says lumpy, where advice and hand-holding and helping people through a difficult time, letting them know they're going to be fine financially, of course, fact-based, there's not a dollar amount you can put on that. Now, going back to specific fees and numbers-wise, I would say that most commonly in the industry, the public is paying a firm simply to manage, well, I shouldn't say simply, to manage investment accounts. And so the process might be around the risk tolerance and, duration until they want to spend the money, all of that stuff. And that's fine. However, we are holistic in our planning. So while we do what I just described, which would be, let's just call it a tie in value with firm X. However, we're also doing tax mitigation and tax planning. We're also doing charitable giving. We're also doing estate planning. Our process is much more thorough. We look at their insurance planning, risk management. There's a lot more stuff. Now, for any one couple or client, not all of the value that and resources that we can bring to bear are appropriate to bring to bear. But for all of our clients, it's much more than just simply, rebalancing their investment account periodically. So that's the biggest difference that I see when we meet a prospective client, and we meet them because they're not particularly thrilled, maybe even unsatisfied with their current firm, but it's also all they know. They might be paying a fee of X number of dollars per quarter or year, and they have no reason at that point to think that we're any different. So that's why we have a very thorough process early on before we would even consider inviting that prospective client to join the PCA family, so that they can become educated on, okay, even if we're just going to charge X dollars in fees that you were paying the other firm for the last 8 years, the value is extremely different, but don't take our word for it. That's what our process is all about, so we can prove it in a fact-based way.
Someone
Absolutely.
who's with an investment firm, a big one, how can they see what they're paying in fees?
Alec, you want to take that?
Well, there's
and talk about our investment audit a little bit as you tie that in.
Absolutely. There's some fees that you can see and some fees that you can't. And this is where I think Ryan and I do a good job of educating our clients on both. What you can see is, as most financial advisors are paid quarterly, on your statement, your annual fee deducted. It should be a line item right on your statement. Should say something like advisory fee, usually 4 times a year, the beginning of each quarter. That's easy, what you can see.
Well, that's if they're a fee-based advisor.
Well, that's correct. I'm making that assumption. Yeah, making that assumption. Yes. The commission world, we'll go circle back to that. What else you would easily be able to find, at least, is what we would call an expense ratio. An expense ratio would be attached to if you own any sort of fund, so a mutual fund, index fund, exchange traded fund. That company that offers the fund has an expense ratio attached to it. Now, that's not going to be shown on your statement. That is deducted straight from the fund balance. So that's something else you could easily find. Now, some of the costs that you can't see would be trading costs. Well, I should say trading costs you could see if the firm has transaction costs for trading, buying and selling that mutual fund or stock. You could typically see that as a commission, $15 a trade, whatever it is. But then what we would call hidden or unseen fees is the cost of trading inside your account or inside the funds that you own that really add up over the course of a year. And that would be by way of turnover. And turnover inside of a fund, for example, when you buy and sell, you don't see these costs, but that's not really technically free. And so just as an easy way of thinking about it, and studies have shown this, that turnover directly relates to costs in your portfolio. So by way of example, if portfolio turnover in a fund that you owned was, let's just say 30%, which means 30% of the holdings in that fund are replaced each year, the approximate cost to you would be 0.3%. So 30, and you could take that up and down, 50% turnover, 0.5% cost to you. So, and I think we'll get into this a little bit. That's part of the reason why we advocate for, if possible, if your situation allows it, pulling money out of making it more transparent by way of owning individual securities versus funds. Ryan, what would you add to that?
Well, I'd just pick up from where you left off there is if you had a stock mutual fund that, let's say in the stock mutual fund, it owned 80 different stocks, or you simply owned those 80 stocks, theoretically, you'd have the same investment risk, but you'd have substantially lower expenses by owning the individual securities, as Alex suggested, because owning a stock, there are no internal fees and expenses on owning a stock. But every mutual fund or exchange traded fund on the planet has internal fees and expenses. And also there's not the same level of transparency. If you own your 80 stocks, you can look and see, okay, I know exactly the companies that I own. Inside a mutual fund, it's kind of like a black box in an airplane. You don't know what stocks are owned at any point in time. So there's less transparency, there's more cost. And also a mutual fund, for example, is a pooled investment. So when you buy into a mutual fund, you're really buying into almost like an investment club. So you own shares of this mutual fund with thousands, if not 10,000s of other people, all with different objectives. And some of those people wake up one day and say, well, I need cash to go on vacation, or I need cash for my kid's college education, or whatever the reason is. But your reason for owning the mutual fund might be just, hey, I want to hold on to this fund and grow my money until I retire in 15 years. Well, all of the people that are buying and selling or those shares of those funds, that is a cost that you have to bear when all you want to do is hold on to the stocks in your stock fund for your objective. So that's one of the issues with a pooled investment like a mutual fund. And so while touches on the turnover and the expense ratio is easy for an advisor like Alex to find, but actually you have to oftentimes look at the prospectus. And if you were looking right at the page, Patrice, you might still not understand it. Some people would. One of the things that we do on behalf of prospective clients, so we do this at no cost initially, just when we're trying to get a sense of their situation, is we have an investment audit that really brings, it's a full physical on a prospective client's portfolio, from their statements, and it gets into the overlap, the various expenses related to it, the risk level of the portfolio and how aligned it is with the owner of the portfolio. It is a deep dive. So somebody that is real micro in the way they look at things, in spreadsheet type people, they would really dig that. At the same time, with the same investment audit, somebody who just wants the big picture, they would get a clear sense of what their portfolio, where it's lacking and where it's doing a good job.
I would love to own all the 80 stocks in that fund. I would love to own this individual company here and there, but it takes time to keep watch on it and to manage it. Is that not worth the fees?
it again depends on the fee, but it is to some people. I mean, I don't change the oil in my car anymore. Actually, that was a thing, Alec, 40 years ago, 50 years ago. But yeah, to me, and I see this with wealthier people, is the most valuable resource is time. And so paying people to do things when you have the means to do so that you can recapture time. For example, for me to play with Lincoln, my 11-year-old, those guys, I mean, that's where you get to the individual household and what are their objectives? What are the driving reasons and purpose behind paying fees? So even if you have the same fee, same age, same everything, one person might look at it as, I'm just going to outsource the work so I can recapture time to do stuff I enjoy more. Mm-hmm. So that's what I take from you bringing up that point, Patrice.
Ryan, I would put it this way. In my belief, someone should hire a wealth manager if they don't have the time, desire, or knowledge to do what we do. And I would argue if you're lacking even just one of those things, you won't do a sufficient job. So that's the way I would put it. And that's what I would argue.
All right.
I got to take that volley. Because here's also, we likely would not be our own heart surgeon. We likely would not be our own attorney if we had to defend ourselves against allegations that were untrue. And so there's just difference. If you want to manage your own money, it is extremely likely, and I have seen so many studies over 3+ decades in my career that show that just the rate of return for individual investors relative to the market is way off.
Yes.
Way off, because I'm not going to get emotional about my client's portfolio. I'm going to ask a ton of questions. I'm going to listen intently. We're going to remain in ongoing close contact because things change and outlooks change and all that sort of stuff. But when we choose investment strategies, they're going to be very customized for that particular client. But the headlines of the day, that's noise. The short-term performance of the market, it's inevitably going to go up and down. That's noise. If the objectives don't change, then we're going to stay, have our eyes on the prize. And what we've seen is that retail investors and do-it-yourself investors buy high and sell low. Market has difficult time. They get scared. At some point, they say, I can't take it anymore. They sell out. So that's problem number one. Problem number two is they have to predict, which nobody can do, when is the best time to get back in.
Yeah.
Well, emotionally, they get back in when it's sunny skies again and everything's, the market has rebounded and they buy high. Study after study after study has shown that. And I don't have it at my fingertips, but Vanguard did a phenomenal study. I want to say it was about 2016. And the intent of the study was to quantify the value of a advisor using best practices. And their value, Vanguard's value, and Vanguard changed the industry with low cost index funds that do-it-yourselfers love. So it was an interesting firm to do this study. Yes. But they came up with approximately 3%. They said the value on an annual basis of an advisor using best practices, this would be around asset location, tax efficiency, security selection and allocation, and a number of parameters, was 3% annually. But as Alex said much earlier in our podcast, they also made the point that the value is lumpy. But it is, and I've got that study somewhere if anybody in our audience would reach out to us and want to see that. But you could probably find it with an online search. It was Vanguard.
Advisors Alpha.
Yeah.
And one very important point there to tie in what I said earlier is it attempts to quantify of the 3% of added value that an advisor might add over the course of an investor's lifetime. It attempts to quantify
3% annually, to be clear.
Annually, excuse me. Yep. All those things Ryan mentioned, asset location, diversification. It breaks it down into how much of the 3% is made up of each of those categories. But the largest category by far, maybe something around 2/3 of that 3%, is behavioral coaching. So the vast majority of the advisor's value over time to gain that 3% annually is from us helping our clients make good decisions.
Yep.
By far, that was the largest category. And it was something around 2/3 of that 3%.
Yeah.
So as a fiduciary working in their best interest, which includes telling them when their ideas are not in their best interest, can be a component of it. Just we try to prevent people from doing stupid stuff.
Well, how can someone reach you if
I
they
say
are
that with a
afraid-
smile on my face as we tie this together. I don't want to offend
Absolutely.
anybody.
Well, how can someone reach you if they want to talk about a decision that they are afraid might be stupid?
Well, if that last comment did not scare anybody away, you can always go to our website at www.poterack.net. That's Poterack.net. You can also see us out in social media on Twitter, Facebook, and LinkedIn, where we distribute podcasts like this and blogs that I write. Much of that is also saved on our website, but we'd love to get better acquainted with you at some time.
All right. Well, to fee or not to fee? That may be the question. Follow this podcast. Life isn't lived on a spreadsheet. To access current and past shows, we also ask that you like and share with others. I'm Patrice Sikora, and thanks for being with us.
Thank you for listening to Life Isn't Lived on a Spreadsheet. Click the follow button to be notified when new episodes become available. To ask questions about topics covered during the show or get a copy of Making It Count, Life Isn't Lived on a Spreadsheet by Ryan Poterack, visit www.poterack.net or give us a call at 704-366-5776. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Poterack Capital Advisory. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. Poterack Capital Advisory does not offer legal or tax advice. Please consult the appropriate professional regarding your individual circumstances. Nothing contained herein is to be considered a solicitation, research material, an investment recommendation, or advice of any kind. The information contained herein may contain information that is subject to change without notice. Any investments or strategies referenced herein do not take into account the investment objectives, financial situation, or particular needs of any specific person.
Product sustainability must be independently determined for each individual investor. Poterack Capital Advisory explicitly disclaims any responsibility for product suitability or suitability determinations related to individual investors.